Hello traders, Gary Wagner here, approximately 10 o'clock in Honolulu, 4 o'clock in New York on Friday, finally 17th day of May 2013, and this is the daily report for gold and silver, our weekend review, and oh what a week it's been, crazy to the downside. We'll talk about it in a second, but technically speaking, there is absolutely enough evidence to see that we have seen a fundamental shift in the marketplace from bull to bear. Bull market starting roughly in 2008, and these last breaks down really are putting the final nails into the belief that we are now in not a bear cycle, but a bear market within the precious metals markets. Off about $28 in gold, as you can see, 1357.45. Low is 1354. We're just off the lows with a high of 1389.30, off about 2% on the day, almost $30 on the day. Of course, we have a raging stock market, one. We have a very, very strong US dollar, two, and those two factors are greatly influencing the current price point in gold and silver. Silver is having the same type of downside pressure in terms of percentage losses. Gold is off about 2.04%. Silver is off about 2.16%. Low 2209, high 2285. Current 2217. On today's show, I will talk about where we believe this downside could terminate, where we find support in the market, and what is our short and longer term view in gold and silver, all here on today's daily report. You know, there's absolutely no doubt we have had a fundamental shift in market sentiment in the precious metals markets, and it is my belief that more and more what we are witnessing right now is the precious metals markets changing from a bull market that was in a bear correction to a bear market. We'll talk about the reasons for that conclusion on today's report. First, looking at an hourly candlestick chart. It is in Japanese Henkin format. We take a look at the last week, and as you can see, starting from about 1470, these were the series of tops that we talked about. It was absolutely critical that we close above this particular price point. We talked about this infinitum, that if we didn't see real closes above this, then we weren't getting any kind of compelling technical evidence that that April bounce off of the 1320 as the market rallied. It was a great trade for us, but at the same time, we needed to see closes above that. As you can see, we in fact did not. When we take a look at the recent trading activity or price action within the market, you can see here through the week, we have had a succession of lower lows and lower highs as we move down. Market moves down, makes a lower low, this high compared to this high, lower high, and all the way down. That obviously is very, very characteristic of a market that is trading drastically lower and under pressure. Now, to really illustrate that point, before we look at some of the technical studies today, just taking a look at a straight weekly chart, you can see the kind of damage that was inflicted in gold this week. Now, we're looking at continuous COMEX contract of gold, weekly chart, straight candlestick format, and we talked about this yesterday, so my daily viewers are well aware of it. And what I talked about was the fact that typically as a market moves up, and bear with me on this, typically at the top of the market, we get many times what's called a three-river evening variation. Happens a lot on the tops. Morning variation happens a lot on the bottoms. And what we're looking for is, as the market comes up, you get this large green candle, and that signifies really the last kind of hurrah of the bulls. And then from that particular green candle, you'll typically get a star gapped above it, or in a continuous contract, it will be gapped right at it. And in this case, for example, you get these two dojis. That is then followed by the final candle for the pattern itself. And So you get the green, the star, and the red. And then finally you get what's called a confirming candle, which has got to be a red candle with a lower low and a lower high. And so you can see how this really fit the bill. First criteria being after an uptrend. However, this market's been in a defined downtrend. And what we talked about yesterday was the fact that we have the green candle, we have the doji starlight candle that's gapped above it. Now, you don't have this long body of a red candle, but we talked about yesterday and on Wednesday, this confirming candle right now is really strong. Look at the size, and it's absolutely just within dollars of this 1320 bottom here. Now, you can see what I believe to be the primary driving force right now within the precious metals markets as investors move capital out of safe haven investments into the equities markets. This is the daily S&P, record high, record high. You can see that over this last week, we only had one yesterday in which the market traded down. Again, it has overtaken it at 1667 currently. Now, just as we do with gold and silver, I've converted our daily chart standard Japanese candlesticks into the Japanese average. And as you can see, as we witness these record highs in this uptrend, look at this. You've got absolute absence of these lower wicks on the way up. You've got nice body size. Now, the body size is contracting just a little bit compared to, say, 4 days ago or 3 days ago. But nonetheless, it is a strong rally to the upside. And if we compare it to other rallies, look at the relative size of bodies here. Fairly weak, contracts a little bit, fairly strong, sideways a little bit. You can see this spurt up, the strength of that by the size, the body size, and the strength of this retracement right here. So this market, in my opinion, has more steam ahead of it. I don't think we're going to witness this market really fall apart right now. We'd have to have some extremely volatile news come out to really have a dynamic shift there. And as long as we have this type of movement to the upside in the equities and movement to the upside in the US dollar, that can do nothing but literally put pressure on the precious metals market, specifically gold because of its safe haven asset classification within investments. Now, of course, we're not witnessing anything as dramatic as what we saw when the market dropped from 1580 down to 1320, and relatively short period of time, no more than a couple of days, 2-3 days in the marketplace. This is that April bounce that we talk about, moves it back up to around 1470, just below it. This top here is at 1480. Let's go draw a line across that. But as we talked about, and for those of you who recall when we were long in this market back here, it was the fact that we collectively were never able to close above this 1470, 1480 area that gave us our first real insight that what we were looking at in terms of this rally up was a technical bounce off of the recent sell-off that we saw rather than a key reversal. If anything, what we've been witnessing really could be construed as a key reversal from an absolute bullish market being a bull market and going through an Elliot wave cycle of a bull cycle to a bear cycle. And we'll talk about that as we pull up our Elliot wave chart towards the end of the show. As we said, there's absolutely no doubt we've had a significant change within the market. And the question that we're going to be asking ourselves, and what's critical right now, is where will we find absolute support in this market? There's a couple of areas that are Fibonacci based. We'll talk about those in just a few moments. But here's what I really believe we have been looking at. And I need to draw another line at around 525. That's right here. And this is what I see. We had a steady, nice up channel in the market. This lasted for years. This was a very, very easy market to trade. You simply bought and you hung on until it reached new highs. Of course, what happened, in my belief, is this. As the market traded it traded where you'd have a spurt, and then you'd have some sort of a contraction. It would retrace a bit, you would get a spurt, and then you would get a little bit of a retracement. However, that changed realistically, call it between April and July. Really, July being where this market sparked. That this is the beginning of course, July 2012. And what I'm thinking is this: if you think about a rocket ship just being shot into space, and then as it hits and runs out of fuel, so to speak, it then obviously is going to fall back to Earth. And there was a safety net, and a strong safety net. This is our support area at around 1525. It hits it this first time here. We get a subsequent bounce, but of course we know that these bounces really stalled at 1800. We had really three of them. We had this triple top right in here, and each time the market fell, it was able to get caught by that safety net. Each time the market fell, the second time, it was caught by the safety net. And then on this last fall, although we were unable to take out 1800 on the top side, as the market fell, that safety net was breached. And you can see the kind of really strong momentum that we witnessed as this market broke. We'll go ahead and blow this up, but 1524 roughly being right around here. And once that was breached, as you can see, we had tremendous force to the downside. And so in essence, what I believe is that the market went up much too quick, much too fast, and has been this oscillation between 1800 and call it 1520 has been the market trying to find the logical place that it was going to trade at. In other words, fair market value. And so what we witnessed just recently, of course, is as this market broke through, that's right in here, we had this tremendous drop to the downside. We watched the market drop from just above 1600 to just above 1300, that $300 drop. And then we had that April bounce, but the April bounce, of course, as we spoke about, was not able to really go above a key area. I labeled it as 1470, and now we see this downside pressure, and we are once again flirting with these lows at 1320. Now, there's no doubt you can really see how much of a failure this last little spurt up was, and how close we are to flirting with a very, very critical area. We'll talk about key levels of support right now. I don't think resistance is going to come into play at least next week or the week after. I think that we are going to see some sort of bottom next week, but I'm not looking at that anymore as a key reversal. Rather, I'm looking at it as a upside corrective bounce in a downside bear pressured market. And so we're looking at this 3-day continuous contract. When we take a look at really the dynamic shift, as you can see here, I've got a long count of 1, Elliott wave count 2, 3, 4, and then 5. What gave many Elliott wave technicians so much trouble in this last series of corrections was that it wasn't really reacting in a way that we had seen typically in a market that's going through a typical correction in a bull market. So that when we had this A, B, and C, we felt, okay, we might have seen the end of the correction, but we failed again at 1800. The market then comes back down, and of course we have this tremendous band of support down at around, call it 1520. We also had a compression triangle in which the characteristics of the market was a descending top and a flat bottom. We caught this beautiful breakout here, but the key is this. Right now, what we are looking at is probably a key reversal in the way that we do our Elliott wave count from bull to bear. And what's the key difference? Well, the key difference in a bull to bear count is in a bull count, you're going to have your 5 waves in the impulse phase having the three primary waves, meaning waves 1, waves 3, and waves 5 are going to be in a bull market, obviously, upside moves. Your corrective waves, which are always going to be in 2 and 4, are going to be counter waves or to the downside in a bull market. Now, in a bear market, you're still going to get a series of 5 waves, but you're going to get wave 1, 2, 3, 4, 5, A, B, C. And then you'll go again, 1, 2, 3, 4, 5, A, B, C. So you're getting the same 5 impulse, 3 corrective A, B, C. However, it's going in reverse. So we have to ask ourselves, if we had an A, B, C here, this being that final counter rally, would it be correct to say that this is wave 1, wave 2, wave 3, wave 4, and we are in our 5th wave down? If that is the case, then we will look for our bounce here, but our bounce here again is going to be about 50 to 75% of the move of this long move down. That would be a tremendous bounce, but again, it would not be a bounce that we would look at as a key reversal, rather a corrective wave found within a bearish impulse cycle itself. That's the first thing that we want to look at. Second thing we want to look at is major points of support. If in fact we hold this level, 1320, here you're seeing it at 1335, and this is a very, very long fib retracement. Let me pull this into alignment so you can see where we're looking at it. This fib retracement really encompasses pretty much this entire rally from the end of 2008 when the market was trading at 731 up to the top when the market was trading above 1900. When we consider that move, you've got a 50% retracement. Now on a wave 2, if we want to look at really the big picture, that can take us all the way to 61%, which would put us just below $1,200, $1,192. So our real target areas right now, should the market not hold this 1320 area, we will look for some minor support at these tops right here, which are just, if I recall, just below 1300. You will get some minor support, and then major support is not going to come into play till about $1,200. That's a 61% retracement. Now, the key right now, as far as I'm concerned, is that in all my time of doing the gold forecast, I have never seen such bearish sentiment in the precious metals markets overall. And the way to look at that is that many times at the end of a storm, when people are the absolute most bearish, the sentiment is turned to 90, 95% bearish sentiment, that is a time to also look at a bottom in the market. So, not that I want to give us conflicting signals, I'm pointing out what the evidence shows us, but at the same time, realize that it is typically when people are the most bearish and really think the sky is falling in, is when something unexpected happens, and that unexpected action, of course, is the market reversing. So, although there's no evidence to support that, the fact that this market is trading within some defined parameters, meaning that if we look at the big picture, and the big picture is a move from 700 to 1900, tremendous move, 50% retracement of that, it's all in line. Whether or not we will see the market hold 1320, that's a pretty critical area, because if it does, we have a couple of different models or scenarios to look at. If it falls or breaks below this critical area, well, then all bets are off in terms of finding any kind of potential bottom, and the next real level, strong level of support is down around $1,200 per ounce. As this unfolds, of course, we will have different strategies, and one of the things that you'll notice on the website is that where proper action typically is when we're in a trade and we have been sidelined for the last week, I do have many traders that are going short the market, so I'm putting out what's called simply market sentiment if I think that it's proper to maintain your short position, if it's proper to enter the market with an initial position, whether you're buying or selling, and give you my overall sentiment on the marketplace itself. Now, there is one more model that I do want to look at before putting this chart away. And that model is simply looking at this large C wave here as having a 5 count. And in that 5 count, we are in 5 out of 5. And the way we would look at that is as follows. C wave has wave 1, 2, 3, 4, and then our 5th wave down. Now, where would that 5th wave take us? Big question. But there is a number of Elliott wave technicians right now that are looking at this as a plausible count and having our C wave, of course, conclude at the end of this 5th wave down. If that's the case, there can be a collective argument made for the fact that we have had a severe correction, but we're still in a bull market. As the evidence comes in, these breaks that we have had, the significant break being really below 1524, and then the tremendous break below, or inability, I should say, once market hit 1320 to fail at 1470, tends to put weight into the camp that believes that we have entered a bear market within the precious metals markets, specifically gold. The jury obviously is out, but the evidence keeps mounting towards that particular faction. But as a subscriber, I want you to be aware of all the possible models so that you can take this information and use it to make good, effective, profitable trades and investments in gold and silver. Now, of course, silver has been running somewhat in tandem with gold, although there's been a divergence, especially during the bounce. When we had that April bounce, of course, you can see on this weekly chart, we really didn't get any kind of follow through in silver. Is it at a critical point? Well, it's absolutely at a critical point, but more importantly, it is trading below 2270, currently at 2222. I really show support right now at around 2150, that being a major band of support. But traders, consider this. If the market does go into a continued free fall, on a technical basis, you have an entire area almost down to $20, just below 20, before you find any kind of really, really major support on a technical basis. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow. We'll talk to you on Monday for another daily update and review. Bye-bye.